In recent years, Warren Buffett, the Oracle of Omaha, has been acting a bit uncharacteristic, and it's turning heads. Known for being a long-term investor who almost never sells his shares in great companies, Buffett has been quietly offloading some of his biggest holdings, like Apple and Bank of America. But here's the kicker. In just the past year, he sold over $134 billion worth of stocks. So what's going on? In February 2025, Buffett dropped a bombshell in his annual letter to shareholders, and it holds the key to understanding why he's been unloading assets. But to really get the full picture, let's rewind a bit. It's no secret that the stock market has been on fire, hitting all-time highs. Before President Trump's new tariffs, the S&P 500's P/E ratio was at an elevated 28, signaling that the market was overheated. For Buffett, that's a red flag. One of the key indicators he uses to gauge market valuation is the Buffett indicator, which measures the ratio of total U.S. stock market value to U.S. GDP. Before the tariffs, this ratio stood at an eye-popping 188%. To put that in perspective, even during the dot-com bubble, it peaked at 140%, and before the 2008 recession, it was a more reasonable 105%. So, at 191%, it's clear the market was extremely overvalued. Buffett's recent actions are no coincidence. As of December 2024, Berkshire Hathaway's cash and cash equivalents totaled a staggering $334 billion, an increase of nearly 100% from the previous year. So where did all this cash come from? A large chunk of it came from Buffett selling off a massive portion of his Apple stake. In fact, he sold over 600 million shares of Apple in 2024, leaving him with just 300 million shares today. But why Apple? Buffett himself explains the reasoning in a recent clip, breaking down the 3 key reasons why he's building up so much cash. These reasons are critical in understanding his strategy, and they shed light on his bold move to adjust his portfolio. Pay close attention, because this is where things get really interesting. As we dive into Buffett's annual letter, the big question remains. Is he preparing for something big? The market might be on the verge of a correction, and Buffett is positioning himself accordingly. This could be the calm before the storm. Stay tuned to find out what's next in the world of Warren Buffett's investing strategy.
Behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. You will see things you won't believe in your lifetime and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but you want, it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. I started selling securities when I was 21, and a Kansas City life insurance company happened to be a fairly prominent company in Omaha, and the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35%. If if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. He's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. And I said, Mr. Moose, I said, you know, you're selling these policies with 2%. You may even have a few members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, you know, a 2% investment on, and you can get 35% on your money. And he said, you know, stocks aren't any good, and I couldn't sell you. You know, I was a lousy salesman. I mean, well, you have to start with that, but it just blew me away. It blew me away. I thought. Sometimes I used to wonder if I was nuts, you know. But those things, the same thing happened. I mean, in 1964, the Dow closed at 864. At the end of 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move. And that, you can't believe how discouraged people were during that period. But, you know, people were living better. So things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing, I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now, that seems pretty, but think about that. And particularly think about it next time you're trying to do something just because the stock's gone up a whole lot, you know, and your neighbor's made money or something. You just have to sit and think objectively and think about, would I buy this whole business? If it's an internet company that's got 100 million shares out and selling at 100, that's $10 billion. Is it worth $10 billion? If it's worth $10 billion, it's got to be able to give you, you know, 700 or 800 million next year. And if it doesn't give you 700 or 800 million next year, it has to give you maybe 10% more than that the year after and continue to. There aren't a lot of businesses that can do that. And people just go crazy.
Did you catch those 3 key reasons Warren Buffett would ever consider selling stocks? Let's break it down. Reason number 1, greed. Over the past few years, the stock market has surged, leading many investors to get extremely greedy. But Buffett knows better. He sees these elevated valuations as unsustainable. A glaring example of this greed is the rise of meme coins in 2024, like the Trump coin, which absurdly surpassed the value of major companies. This kind of speculative madness is a classic bubble indicator. Buffett has made billions during past crises like the dot-com bubble and the 2008 recession. He knows a crash is coming, and he's positioning himself for it. Reason number 2, earnings yields. Before Trump's tariffs, the S&P 500's PE ratio stood at 28. If you reverse that into earnings yield, it's just 3.57%. Meaning for every dollar you invest in the S&P 500, you earn just 3.57 cents annually. But here's the kicker. If you invest that same dollar into a 3-month treasury bond, you'd get 4.3% annually. So, would you rather take a risky bet on stocks for 3.57% or a guaranteed return of 4.3%? Buffett isn't stupid. He knows bonds are offering better returns than stocks right now, and he's shifting more into short-term bonds. Buffett has seen this before. Back in the day, he could invest in an insurance stock with a 35% earnings yield or collect just 2% from bonds. Guess what he chose? 35%. But today, the situation has reversed, and Buffett's not ignoring this massive disconnect. Number 3, sustainability. How much longer can the market keep climbing? If it were to rise another 50%, the P/E ratio would spike to an unsustainable 42.85. This would push the earnings yield down to just 2.3%, essentially guaranteeing poor returns for investors. Buffett is asking the big question. How much longer can this market madness last before a major correction happens? The answer? Not much longer. So, let's connect these reasons to Buffett's most recent shareholder letter. In 2024, Berkshire Hathaway's performance exceeded expectations, despite 53% of their 189 operating businesses seeing a decline in earnings. But here's the important part. Buffett highlighted how a large gain in investment income from treasury bills helped buffer the downturn, leading to a surge in Berkshire's short-term cash holdings. He emphasized that while Berkshire's holdings in marketable equities decreased from $354 billion to $272 billion, they've heavily increased their positions in liquid short-term securities. Why? Because Buffett believes that For now, bonds are offering better returns than stocks. However, Buffett made one thing crystal clear in his letter. This is a temporary shift. He reassured investors that Berkshire will never prefer cash equivalents over ownership in good businesses, especially American ones. Buffett's still committed to the long-term game, and once the market corrects, he'll undoubtedly pivot back into equities. So why is Buffett selling stocks? The market is overvalued, plain and simple. Right now, he's holding cash and bonds until the market corrects. But when that crash comes, he'll be ready to pounce on undervalued equities once again. If you found this insight into Buffett's strategy valuable, hit that like button and consider subscribing. I'll see you in the next one.